recession needs to be persistent, profound, and pervasive. Is our inflation persistent, profound, and pervasive?
Well, I think, Tom, we're in an environment that's quite unique. I know there are a lot of desires to compare the current situation to prior instances, prior cycles. We were just talking about the housing slowdown. I don't think we're in the 07, 08 type of environment. We have household finances that are generally still healthy in terms of wealth at elevated levels, in terms of leverage at 20-year lows, and in terms of excess savings. Those are good conditions entering this type of environment where there will be a slowdown led by interest rate sensitive sectors. That is, as we were saying, what the Fed intends to do. It intends to cool demand. The housing sector alone is not enough. It wants to cool the broader set of indicators in terms of demand and hope that inflation follows suit. So I would expect to see persistence in inflation, but I think the key theme on the inflation front is going to be that divergence between headline inflation and core inflation. Headline inflation is going to cool with accelerating momentum thanks to energy prices, but core inflation is likely to show more persistence going into next year.
Greg, you just went through the strength of household balance sheets and you brought us some aggregate numbers. When you look at low income, middle income and high income households, is the same true from one group to the other?
Well, I think we are going to come out of this COVID crisis with a K-shaped recovery. I know the K-shaped recovery was the theme of last year, but I think we have to be conscious of the fact that inflation is not affecting everyone in the same way. So lower families that spend more on gas, on rent, on food are likely to be disproportionately affected by this high inflation environment and see their ability to spend being constrained. The higher income families, less so. Inflation is still going to be a concern and a constraint on spending overall, but it's not going to affect everyone in the same way. I think when we look at the housing market and the direction of the housing market, what we are starting to see is that there is this weakening in home sales, which has already occurred over the past 6 months. That's feeding through to home builder sentiment. It will feed through to starts. I think there is further to go to the downside in terms of housing activity, but that will take place over the next few months. It's not over yet. We're likely to see some further downside on the housing front when it comes to overall home building activity.
So what are you looking for, Greg, in order to determine how deep the downturn will be? We talk about soft landing and hard landing, and it kind of conflates this idea of a slowdown that is probably expected across the board. What are you looking at?
Well, what I'm looking at is what businesses are doing. We are in this unique environment where businesses that we talk to are still talking about hiring workers at a slower pace, but they're still talking about hiring workers. We recently hosted the EY CEO Roundtable, and one of the key indicators that I paid close attention to is what I call the talent gradient, how companies are reacting to this expected slowdown in economic demand. And what we are hearing is that businesses are looking to initially slow hiring rather than proceed with massive layoffs. That's the first option, slow hiring, then strategic hiring freezes, then strategic layoffs, and then more broad-based layoffs. But the talent gradient has moved up. And what that means in terms of the potential for consumers to continue spending is that that should support household income going forward. The same is true for business investment. Businesses are still looking to build resilience. They're not retrenching. And that's another encouraging sign in terms of this potential recession being milder than the prior ones that we just lived through.
At least for the upper tiers, or the middle class and the upper middle class and the wealthy, but not necessarily the lower class, Greg, which are being hit on both sides, right? You're seeing the cutbacks happening more there because there aren't the workers and the wages are going up much more quickly. What are the longer term consequences of the K-shaped recovery that you're talking about?
Well, I think one of the key consequences of this K-shaped recovery is that we're going to see a different approach to labor going forward. We're going to see an approach in which labor is viewed as much more valuable than it was pre-COVID, an environment where there are difficulties to find the appropriate labor, to train them, to pay them, will mean that companies are more likely to retain their workers with more interest. But they are going to be strategic when it comes to which sectors they're working in. Sectors that are seeing the more severe slowdown in economic activity are likely to be the ones that transition more at a faster pace from this reduced hiring process towards more massive layoffs. So we are likely to be in an environment where both higher inflation and higher interest rates and this different talent gradient affect the response of consumers and their ability to navigate through this period of uncertainty. But really, my key focus right now is what businesses are doing. We know there's a consumer slowdown underway. We haven't seen yet a massive slowdown in terms of business investment and hiring, and that will be key in gauging whether we do end up in a recession and how severe that recession is.